Hey everyone, 2022 was a roller coaster of a year and not really the pleasant type. What does 2023 have in store? Well, that's what you're about to find out. In this video, I will talk about the outlook of the main economic and investing factors in 2023, like inflation, interest rates, economic growth, before looking into what that actually means for us and what to look out for. Don't forget, overall stock performance tends to be driven by the macroeconomic factors, so it's important to know what they are. If you're ready, leave a like and let's dive in. First of all, the question on everyone's minds: has inflation actually peaked? Will we see higher levels of inflation in 2023 or not? The good news is that inflation has probably peaked for now. The biggest portion of the jump in inflation was contributed to gas and overall energy prices. Obviously, the war in Ukraine was a big factor, but that wasn't the only cause behind rising gas prices. There is a lot of green policy that has been implemented in Europe and America that has affected gas prices and reduced current and future supply. Still, gas prices seem to have stabilized for now, and given that we are close to the middle of winter and past the usual yearly gas spike, the likelihood is that gas prices will trend lower. Of course, it depends on government policy and whether gas reserves have been replenished, whether governments in Europe want to stack up on gas while the prices are lower, etc. But generally speaking, we shouldn't see higher inflation in the first half of 2023 because of gas or other energy prices, although that may change by the end of the year. Another big chunk of inflation came from materials shortages, especially the chip shortage. Unfortunately, that one is expected to extend through 2023 and possibly even 2024, so it will continue to put inflationary pressures. There are also shortages in various building materials like steel, bricks, timber, and even cement. Some food categories are also seeing or expecting shortages in 2023. If you live in the UK, you probably know the struggle of buying fresh eggs. However, what we need to realize is that extremely loose monetary policy set the table for this inflation spike. Central bank monetary policy usually encompasses two things: interest rates and money supply. Over the last 10 to 15 years, we saw the lowest interest rates ever in the history of the US, UK, and the Eurozone. In 2020, we also saw the start of a massive jump in M2 money supply, which continued until a few months ago. If you don't know what M2 money supply is, well, that's basically the total money supply in a country, including all of the cash people have on hand, plus all of the money deposited in checking accounts, saving accounts, and other short-term saving vehicles, such as certificates of deposit. There's been a lot of discussion around M2 in recent years, and generally it's accepted that it's a reliable inflation prediction indicator, especially when you see a sharp rise in the money supply. However, some central bankers like Jerome Powell do not agree with that. In September 2022, he claimed that there was little correlation between money aggregates like M2 and inflation, essentially saying that printing money does not have a big impact on inflation and that he doesn't consider it to be a reliable indicator to use when thinking about policy. As the chairman of the Federal Reserve, his opinion carries a lot of weight, but he's drawn a lot of criticism from economists about that. You can see why when you look at the charts. US and UK M2 money supplies went up by about 40 and 30% respectively since March 2020. That's a lot of added money in just 2 years. Same goes for the Eurozone, which has seen an increase of just over 20% in its M2 money supply. Now, both the US and the UK, along with the Eurozone, are seeing the highest inflation levels in 40 years. On the other hand, we have countries like Switzerland, which did not engage in the rapid money printing like the UK and US did. Instead, the Swiss money supply has been rising gradually but slowly since the Great Financial Crisis. Was the Swiss inflation rate? It peaked at 3.5%, which was the highest in 30 years, yes, but it was just 3.5%. Compare that to the US peak of 9% and the UK peak of 11.1%. It's worth saying that the M2 money supply by itself probably has a limited effect on inflation, but when you combine it with other inflationary pressures like supply shortages, the opening up of economies post-COVID, rising wages, you get a very dangerous mix. So, should we be worried about the monetary policy? Well, the good thing here is that the US, UK, and Euro central banks started tightening a few months ago and plan to continue to do so until they've brought inflation down to their target Goldilocks rate of 2%. For them, tightening means reducing the money supply and hiking interest rates. The Federal Reserve is expected to hold interest rates at around 5.25% during 2023, while the Bank of England is expected to hike rates up to the vicinity of 4.5% in 2023, before starting to cut them between late 2023 and the middle of 2024. The European Central Bank currently has an interest rate of 2.5%, but has already started to slow down on the hike, with the latest rate hike being only 0.5% as opposed to the previous 0.75% hikes. Most analysts expect that the ECB will hold rates at about 3%, although some think rates are more likely to hit 3.75% before pausing. Still, we can already see that inflation is going down, although we can argue whether it's a result of central bank policy or simply a result of gas and overall energy prices correcting. So, this tightening must be good, right? Inflation must surely be kept under control. Well, sort of. Yes, this will likely control inflation levels, but there is a trade-off. There is always a trade-off. Hiking interest rates and lowering government spending means slowing down the economy. Given that economies have gotten used to the loose monetary environment, this tightening will hit them hard. Officially, economists and banks expect the UK will enter a recession in 2023, although there is a debate over how much GDP will shrink. Just a side note, a recession is generally identified as 2 consecutive quarterly drops in GDP in the UK, although other countries like the US need to see a decline in payroll employment, personal income and spending, industrial production, retail sales, and so on. When it comes to the UK, estimates vary. For example, CBI expects a 0.4% shrink in the UK GDP in 2023, whereas KPMG and Goldman Sachs expect 1.2 to 1.3%, and the UK's Office of Budget Responsibility expects a drop of up to 2%. Generally speaking, I don't think anyone expects that the UK economy will grow in 2023. One big factor affecting the UK economy is the large percentage of house owners with a mortgage, which will be negatively affected by the rising interest rates. There's a similar expectation around the Eurozone, although the major consensus there is that there will be zero growth, zero shrinking, and GDP will remain roughly the same, or worst case scenario, dip by up to 0.5%. What about the US? Well, things aren't looking rosy there either. Bank of America expects US growth to grind to a halt in the second half of 2023, or even enter a small recession. The consensus amongst economists surveyed by Bloomberg say that there is 70% likelihood of the US entering a recession by the end of 2023. So, we have small recessions expected in the US, UK, Eurozone. It's not great, but it's not terrible either, right? Maybe. See, when we're looking at these forecasts, we're looking at opinions and consensuses and all that. These are expectations. These are not facts. Now, expectations are important because investment managers, asset managers, banks, retirement funds, insurance companies, basically most of the financial world out there in the private and public sectors need them in order to form their strategies for resource allocations. They simply need to know what to expect. As a result, the markets worldwide reflect those expectations, especially the expectations for the next 3 to 6 months. The problem here is that reality is often different. Economic forecasts and expectations are notoriously wrong. Big moves in the market happen when the reports hit, the figures get released, and they're different from the expectations. In fact, sometimes those moves happen in the 1 or 2 weeks leading up to the releases. That's why negative results sometimes cause a market rally and positive results cause a drop. Difference between facts and expectations cause all of these financial institutions to adapt their strategy, move assets around, and we see that reflected in the markets. Most importantly, these differences may cause the central banks to change their actions, and when central banks change their mind, the markets change. So, why am I talking about this? Well, we've seen the official estimations, the official forecasts, and so on, but are these estimations likely? Are they accurate? To an extent, yes. Given everything that's happened over the last 2 years, the chances for positive macroeconomic developments and GDP growth in 2023 are slim, so I agree with the forecasts on that note. Where do I disagree with them? Well, I think there is a high chance that the recessions we will see this year will be worse. In fact, I actually suspect the central banks expect this too, and they're just managing the expectations of the public. If the Federal Reserve came out and said something like 2023 will be horrible and GDP may drop by up to 10%, people will go nuts. There will be widespread panic and hysteria in the markets, sell-offs, and the resulting financial turmoil will be much worse. Instead, they're playing clueless and saying, yes, Things will be bad, but they won't be horrible. As the rest of the financial world accepts that, expectations will slowly decline and decline. The question here is how low will they go? Well, Michael Burry, along with Nouriel Roubini and Steve Hank, who are currently the third and fourth most influential economists in the world, believe that we will start seeing the beginning of a recession at some point in the second half of 2023. They think that the recession will be harsher than expected and longer, and that will force central banks to intervene again, which will provide a short-term fix, but will only make the underlying problem worse, incur even more debt, cause another inflation spike down the line. If you think that's unlikely, just take a look at what happened when UK's Liz Truss announced her mini-budget. Within 24 hours, the Bank of England was forced to jump in and intervene and do more money printing, or quantitative easing as they call it. The bank systems are fragile. Maybe the UK one is more fragile, but the US and the EU are not that far behind. Just take a look at the total debt levels. The US federal debt to GDP level is currently 120%, slightly down from the peak of 134% in April 2020. US federal debt levels have only once been this high before. That's close to the peak of 121%, which happened right after the Second World War. In reality, it seems that the central banks and economies just need to face the facts, take the hit, deleverage and clean the slate so the cycle can come to an end and the new cycle can begin. Will that happen? I doubt it, but you never know. To summarize the outlooks, the chances of 2023 being a positive year for the US, UK and Eurozone economy are slim to none. We will almost definitely see a recession by the end of the year. Currently, there is a massive yield inversion in the US bond markets too, which has historically preceded a recession. Now, yield inversion has become a very mainstream recession indicator, and banks, companies and consumers all follow it to the extent that its predictive power has now diminished. Why? Well, once companies and consumers see a yield inversion, they tend to become more careful in their spending because they expect a recession, and that can actually result in a stronger economy. Still, we can see that there are some worrying signs that signal we may see the US entering a recession in 2023. Obviously, we need to see more data to confirm that, but I think we have enough to warrant extra caution. So, where does that leave us? What's the takeaway here? Personally, I think it's not the time to be taking risks. Having extra cash on hand will be useful, and despite high inflation, it's probably worth it right now for the peace of mind. Plus, it will help you take advantage of good buy opportunities in the coming months. I'm sticking to broad index funds and dollar cost averaging every week. Broad index funds are always a good call. Even though you have a smaller potential reward, you are also limited in terms of risk. It's also good to spread your exposure across multiple countries, maybe multiple currencies. Obviously, this is not financial advice, just my opinion, but from what I've seen personally with emerging markets recently, I would not put more than 3 or 4% of my total portfolio there. In times of financial turmoil, emerging markets are likely to take a harder hit, see higher inflation, higher unemployment, currency devaluation, and so on. The index funds that I'm investing in are Fidelity's Global Shares Fund, which has a low fee and has only 2/3 of its assets in the US, with the most of the rest being in other developed markets in the Eurozone, Asia, Japan, Canada, UK. I'm also getting the UK's FTSE 100 and the MSCI Europe ETF. Even though the UK and EU economies aren't looking great, their indexes have actually a relatively big allocation in the base materials sector, which I think will do relatively well over the next year. Plus, they're also more geared towards value instead of growth like the US. Gold is a good hedge to have too, probably somewhere between 5 or 10% of total assets. If you're looking at individual stocks, personally, I would avoid highly priced growth stocks, especially ones with negative earnings. Avoid companies with high debts because their interest expenses will only keep rising. What we'll do best now is companies with a good real earnings and free cash flow yield, basically value stocks. Consumer defensives, healthcare, those type of companies are likely to remain stable. Dividend companies also provide good reassurance, but make sure that they can afford paying their dividend. There is so much more that can be said on the topic, but I hope I have covered the main highlights. If you want to learn more about stocks and other assets that do well during inflation, check out my other video here or in the comments below. Currently, I'm also focusing on building good dividend yielding portfolio, so make sure you subscribe if you're interested in that. I hope you found the video useful. If you did, please drop a like, share with friends, comment or subscribe. Thank you very much for watching, and I will talk to you again soon.